Wednesday, April 4th, 2018, Monaco 64, home of alternative economics and contrarian views. Before I start, I'd like to thank everyone who donated to the channel. I appreciate it. The video I made yesterday talking about that did not get the yellow icon, so it was came out as normal. Hopefully this is nothing but a problem with the algorithms and the machines. A lot of you, of course, think it's YouTube censoring my channel. I don't want to speculate about that or make any conclusions. But yeah, so thanks a lot. And today I'll be talking about Libor and the OIS spread, what it means, why it's so important. And of course, I'll look at the markets first. It's just gone past 7:30 a.m. London. So yesterday, the stock market rallied back, got most of its losses that it had the previous day. I saw some headlines saying that it was attributed to the fact that the White House came out and said that they were not investigating or pressuring Amazon for now, and then that Amazon stock rallied strongly. But I think this is just like a short-term noise. As I said, a longer-term trend is still lower for stock markets. So what are we doing this morning? Gold came down yesterday, but it's off the lows, which was around 1328, I think, or 27. We're right now 1334.50, up $1.70. Range has been 1331.50 to 1336 overnight, spot gold. Silver is 1642, up a cent. Range has been 1639 to 1647. So silver is still in a very, very narrow range. The Dow right now is down 118 or 0.5% at 23,912. S&P is down 12. About 0.5% as well at 2603, and the Nasdaq 100 future is down 45 points or 0.75%. Currencies are very steady at the moment. Sterling or cable is up 11 pips, almost nothing, 140.69. Euro is unchanged at 122.72. And dollar is down very slightly against the yen at 106.58. So, some of you have been asking me about Libor and the Libor-OIS spread. First, I'd like to talk about derivatives. I worked in the derivatives market, in the exchange-traded derivatives. What's the difference between exchange-traded and other kinds of derivatives? Well, exchange-traded means that you go to an exchange and the contracts are uniform. The exchange publishes information about the positions. Everyone knows what's going on. It is leveraged as well, but it's, how can I say, it's more transparent and as I said, it's uniform. The other kind of derivatives, which is the bulk of the derivatives, and it's much bigger than the exchange-traded derivatives in terms of notional amount. That's the over-the-counter derivatives, and that's what that means is banks and institutions writing up derivatives for counterparties, and they can decide whatever terms they want, whatever leverage they want to do. I recommend, of course, you watch The Big Short. The main protagonist in The Big Short, I think it was Dr. Michael Byrne, I'm not sure, I forgot his name now, but he has an idea about shorting the subprime the real estate market through the subprime loans. But there is, of course, no security to trade that, no futures or no exchange rate for securities. So he goes to New York, to the major investment banks, Goldman Sachs, Deutsche Bank, Bear Stearns, Lehman's, all the usual suspects. And he meets with them. He tells them what he wants to do. And they say, yeah, we can do that, you know. And they write the terms. And it's not transparent. You will see in that movie that when the market starts moving the way of this fund manager, who was the major guy in the movie, he calls the banks to get a quote, and these derivatives don't move, and he's like, "What the hell is going on? How come, you know, this has happened? This subprime lender is gone bust, and you're still quoting me the same price?" So if he'd done it in a futures market, that wouldn't have happened, because it's transparent, and the exchange, you know, you have more counterparties, the public trading. So that's the problem. OTC derivatives, very opaque, but it's huge. And as usual, these derivatives are very leveraged. And the purpose of derivatives, you go back to the 19th century, for example, with the Chicago Board of Trade. It was farmers and producers trying to hedge risk. They needed to sell their corn, and, you know, forward. They wanted to protect against price movements. But and that's still partly the reason why there are derivatives. But it's become so geared towards speculators and trading. A lot of the banks on Wall Street and the City of London, they use these to basically gamble, use a lot of leverage. And that's why there's so many international banks here in London. There's no rules against hypothecation, i.e. how many times you can leverage the positions over. In the States, there is. So that's the background. All these derivatives are priced against the London interbank offered rate, i.e. You call Goldman Sachs, and you are like a hedge fund. You say, I want to do this and this position, this derivative, and they say, yeah, we can do that for you, and you have to pay us a premium. The terms are LIBOR plus 6 month LIBOR. So they base the contract on the 6 month LIBOR rate. And what is the LIBOR rate? It's the London interbank offered rate. It's the rate at which banks lend to each other in London. And why London? Because from the history of the Bretton Woods system, there was a lot of dollars flowing around internationally, and they did it through the London market in the 60s and 70s. All the dollar outside the US is traded through London. And so a lot of loans, derivatives, they're based off LIBOR. It could be overnight LIBOR, 3 month LIBOR, 6 month LIBOR, 1 year LIBOR. And there's no count. It's how can I say? It's a loan that has no collateral. So the credit risk is very important. It's banks lending to banks. The most important term is the 3 month and 6 month LIBOR. I used to trade for clients a contract called the Euro-Dollar futures. And it's nothing to do with the Euro-Dollar FX rate. It's to do with the dollars in Europe. They call it Euro-Dollar. So if that contract is trading at 100, it means that the rate is 0. So when rates are going up, that contract goes down. And that's leveraged as well, but it's a futures contract. And a lot of the traders in LIBOR, they use the Euro-Dollar future to hedge their positions. So there's a huge, massive casino leverage, futures, OTC. But what happened in 2008, 2007, is that banks in London, the major international banks, they started, how can I say, not trusting each other, especially after what happened to Bear Stearns, some of the London banks as well. In 2000, the UK banks went bust, like Northern Rock, the Icelandic banks. So banks wouldn't lend to each other anymore because or the rate skyrocketed, the Libor rate, because banks were scared to lend even overnight or 3 months or 6 months to other banks. And that's what created the derivatives crisis. Excuse me. You've heard of credit default swaps, CDOs. These are all based on Libor. Maybe now Libor isn't as important, but it still is a big time. So what is the OIS? Well, OIS is the overnight index swap. And prior to the crisis, the spread between Libor and OIS is also a derivative. It's basically the overnight rate that central banks will lend at to banks. So it's basically the central bank rate, but it's a derivative. It's when banks want to swap a fixed rate for floating rate. Before the crisis, the spread between Libor and the central bank OIS rate was like 1 basis point. There was no difference, but then it skyrocketed. I think it went as high as 3.65%. And what does that mean? Well, that means that the banks don't trust each other, and they've put their money with the central bank, because the central bank can always print money. So that's why the Libor OIS rate is so important. If that's starting to spike, that shows that there's a problem in the banking system. What else happened during the crisis? Well, it was reported by the Bank for International Settlements, who regulate the banks by the Financial Stability Board, prior to the crisis, that there was more than 1 quadrillion of notional derivative amounts. And banks always say, oh, it doesn't matter, the notional amount, because there's always a short and a long. But when there's a counterparty failure, like Bear Stearns or Lehman, that all goes out the window. So what did the BIS do just after the crisis? Well, they changed the accounting for the investment banks. Instead of the investment banks having to mark their positions in derivatives to where the market was, the BIS allowed them to mark it to model. What's mark to model? Well, I'll tell you what mark to model is. And let's say mark to model refers to the practice of pricing a position or portfolio at prices determined by financial models, in contrast to allowing the market to determine the price. So it's like if you had a portfolio of cryptocurrencies, and right now Bitcoin is trading 7,300, but you're allowed to actually market to whatever model you think it's whatever to model, financial model. And you say, oh, I think Bitcoin is going to be 100,000 by the end of the year, so I'm actually marking my position to $100,000. And that's what the BIS has allowed banks to do. And they've changed the accounting. Now, instead of having over 1 quadrillion, they've only got like 600 trillion or 700 trillion. And I said only, but it's still a huge amount. And I don't know if you remember well, there was a big scandal about the Libor manipulation. Basically, the London banks colluded, and there's proof also that the central banks colluded, and I'll come to that in a minute. They colluded to lie about the rates, because you have to report that rate every day. There's a fixing for that rate. So they lied about that rate and brought it right down, even though it was a lot higher. And that's what the Libor rigging scandal was all about, because they wanted to show the world and investors that there wasn't a problem. But this is from The Guardian. I'm not making this up. This is from April 10th, 2017. And it says, BBC to air recording that implicates Bank of England in Libor scandal. Panorama, which is the program, says it has recording of 2008 call in which Barclays bankers discussed alleged pressure by Bank of England to lower rates. So not only do these central banks try to manipulate the rates, like normal rates, but also Libor rates. It says the Bank of England has found itself under the spotlight again over the fixing of a key interest rate during the credit crunch, after new details emerged of bankers discussing Threadneedle Street's alleged involvement in setting Libor. Threadneedle Street is where the Bank of England is based. BBC One's Panorama program said it had obtained a recording of a 2008 call between two bankers at Barclays in which the more senior person said the government and the Bank of England were exerting pressure on it to lower the rate it offered for Libor, the London Interbank Offered Rate, which is the interest banks charge each other for short-term loans. Libor is used as a reference point around the world for loans and mortgages and is set each day by a panel of leading banks, with each one submitting the rates at which it is willing to borrow. Revelations that the rate was rigged at the height of financial crisis have led to banks being fined hundreds of millions of pounds from a variety of regulators, while bankers from Barclays and UBS have been jailed. Well, this story has gone off the radar. Why isn't the Bank of England prosecuted? Or why don't they look closely at the Bank of England? It says here, Labour's shadow chancellor, John McDonnell, called for an investigation on the back of the broadcaster's report. And he says, this is an extremely serious revelation that contradicts past assurances about the role of the Bank of England in the Libor scandal, he said. Well, you can see why now the establishment is so much against having a Labour government, because that's the kind of people that they want to investigate that. Am I saying I'm pro-Labour? No, I'm apolitical. So that's why it's so important, this Libor rate. And right now, of course, it is this Libor-OIS rate is spiking higher. There has been some stories lately. Market Oracle reports, it says credit concerns in U.S. growing as Libor-OIS surges to 2009 high. But it's not concerning the U.S., it's throughout the world. This would affect not only the U.S. The other one from Bloomberg here, it says Libor-OIS is ready to tighten. Consider it merely a reprieve. Tighten means that the spread will come in and it will be a little calmer. But this is from April 2nd. Only a reprieve. What else? Yeah. So that's why the Libor-OIS spread is important. Libor is important. There's hundreds of billions of loans and derivatives priced off these rates. Will the central banks try again to tell the banks to lie? Not too sure this time, because they've done it once before. And to those who say there's no manipulation of the gold market, I'm sorry. The Bank of England, they're a big part of the LBMA. Don't you think they'll go, if the banks come to them and say, the bullion banks, oh, we got huge demand for gold, physical gold. These people want to take delivery and we haven't got the gold. Don't you think, yeah, the Bank of England will say, don't worry, you can borrow this gold that we have, for clients at the Bank of England. They lease the gold. So to all those that say that there's no manipulation is rubbish. Banks do manipulate, they've manipulated the Libor. And there's proof that the Bank of England was involved. But for some reason, it comes out in the press and then it's just put to sleep. There's loads of distractions and people don't want to know. It's something that seems very technical for them, but it affects everyone because a lot of credit and loans are priced off this. So that's why it's so important. Yeah, the 10-year yield is also important, but this is also very important. So if you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet. You can also follow me on Steemit, which gives you access to DTube directly, and also on Twitter. And I'll talk to you later. Bye.